Hello ladies and gentlemen, and welcome back. Well, at first this may look like a bit of a messy chart. You've got things going on everywhere and you look at it and you think, what's going on here? Well, in today's video we'll be talking about the concept of maximum pain. That is basically convincing everyone that the direction is going in a certain way, and then of course reversing against that. There are some very important points that we reach or we're about to reach in markets around the world, including stocks, commodities, and cryptos. And we'll be discussing all of those and more in today's video. So let's take a look at it right now together. There's a lot to learn and hopefully some key levels that we'll be seeing very, very soon. Stay tuned, guys. This will be a good one. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. If you like any of those markets, why not consider subscribing? And of course, give it a thumbs up if you find value in our video so far. Let's talk about some macro data, then we'll get into earnings, then we'll get into, of course, the charts, everything about stocks, commodities, and the indices as well. Let's begin though here by consumer confidence in the stock market. Now, a huge portion of why the markets are recovering is because too many people were bearish. And that is the story that we want to go through today, maximum pain. So you can see here, consumer confidence is at lows that we hadn't seen for quite some time. We really alerted everyone here on the channel to this basically back in June into July. It was just really bearish. And unfortunately, so many people were bearish. It really covers why you have to have that bullish run. So far, the price action has come along with that. If we take a look at annual returns and intra-year declines, obviously this year is pretty bad, 24% downwards at one point there for the SP 500. Now it's down a lot less. So is it unusual to see pullbacks in markets? Well, of course, in general, I like to kind of usually apply like a 7 to 8% rule, usually each calendar year. That might be something you want to write down. Usually each calendar year, you can see how many stats we have of 7 to 8 or even 9% declines. This is a bit of a normal during, let's call it the average bull year. But during bear busts, of course, you do have much larger statistics, and that takes our average to 14% return negative at some point. Even with those returns, though, 32 of 42 years were still positive, and it just shows you how fast a lot of these busts can recover. And of course, at this point in time, a lot of people are feeling the FOMO. And rightfully so, you know, many people are calling the bottoms in, and it could be potentially, especially in some of the tech stocks. I always like to come from it, opinion of abundance. So always think about it this way. There's always another trade and always another opportunity around the corner. If you miss one, there'll be another. And whenever you FOMO or just jump into something, it usually just doesn't work out for you. So try to remember that. Let's talk about midterm election years. Yeah, we haven't even talked about midterms, and I've been bringing this up a few times. And the reason why is because midterms themselves tend to actually add to the volatility. We haven't spoken about that. It's been inflation, inflation, inflation. It hasn't been midterm in normal kind of years here. So we see the peak to trough for the S&P 500. If you look at this chart, it's usually pretty damn negative during these years. And actually the average lows tend to happen around August and September. We're just in the start of August at the moment. We've been rallying hard at the beginning, and we might be coming up to a point where things potentially shift. We've been looking and focusing on these areas for quite some time now. We hit the first one, the 20 moving average weekly. We'll look at that later on the S&P 500. But there's 2 points to this story. One, that there might be a little bit more to come. There's certainly potential here. And 2, that if you're a longer term investor, the stats are generally in your favor towards the bull side when you're looking at 1 year later past these points. And I mean, they're pretty nice. I mean, that's 30% on a lot of those averages there. Inflation at the moment is the concern. We don't even have a knowledge yet whether inflation has truly peaked. Of course, we've suspected that since back end of May that we were probably leading into the big peak. It's not really our opinion. It was the opinion of course, the metals and bonds traders that were showing us this on the charts. But this is the component of inflation. Of course, we do know that energy has most likely dropped during this period. Of course, we're seeing cars dropping as well. So new and used vehicles, it's clear as day that that's happening. Food, we don't know. And the rest of them, shelter, probably still showing some signs of inflation at this point. But what a great chart, easy to understand, easy to look at. Now, why do we know that this market's pricing in inflation's peaked? Well, a lot of it's got to do with the forecast for the yield curve moving forward. You'll notice that at the moment, the market in general expects the Federal Reserve to hike, and then to cut coming into 2023. And that's what all of these yield curves are showing you. They're showing you where the market's going to go towards, so that 3.4% plus potentially from the Fed, and then they're going to have to stabilize and potentially cut into 2023, the midpoint of that year. There are some other theories as well out there that the market's got it wrong and they're going to have to just remain at a much higher rate of high rates for a longer period of time. And this is, of course, not going to be good for the market. So remember, if this changes, all of a sudden, you're going to see potential declines on the markets. Continue to watch those rates. And of course, if you want to see them, follow the channel here. We'll always bring them up. Some good signs, though, for the economy in terms of whatever does happen here, we're probably going to get out of it. I always look at household debt servicing. I think it's super important. Do not forget the GFC. Do not forget hundreds of years of history of housing and the potential for people to over leverage. When dodgy lending is around, you have to be concerned. Is this the story of dodgy lending? And I've always said this and I always will. I'm bullish on the US economy still, even if it goes down another 20%. Out of this potential issue. And the main reason is I think people can pay off their houses. Houses are a huge component of economies. If they go down and people can't pay for them and they start fire sailing them, it creates a systemic problem that is horrible. So here we can see too many people were maybe a bit over leveraged. Then it became, of course, insane. And down where we are right now at the time of this recording in 2022, technically in the US, it's kind of more affordable than it has been in the past. It's becoming less affordable as rates go up, but it's still important to see that people have a lot of disposable income to pay down, basically, in many people's cases, their main assets. So midterm election years, we always bring this chart up. Volatility is expected to start spiking sometime in August into potentially September and October. Just remember that. It's a statistic. It's there. At least we know about it. Earnings season beat data, not really any better. Beat still at 1,082, misses 524, 67% beats on low expectations. It's always important to read these. Usually we expect about 70% at this point. And of course, because the expectations are poor, it's not hard to get a number like that. So has this earnings season been impressive? Not really. What do we got coming up? Thursday before the open, we have Baba, we've got Datadog, and of course we have some other hyper stocks such as Cloudflare and Twilio coming through, Block, etc. And this is going to really show us the lie, maybe a bit of an idea about hyper stocks in general, how hyper stocks have performed. If we see more of these upticks, we saw Shop give their report last week. It seems like mostly the market's like that. PayPal, AMD, some of these other hyper stocks, they're kind of just showing us that there's a little bit of momentum through a lot of these earnings right now. So some people are playing that. And if they want to, of course, that's a risk that they're willing to take. So before we go any further and we take a look at the charts and the key levels that you need to be watching, I wanted to say a big thank you to the sponsor of today's video, Tiger Brokers. And more importantly, show you guys some of the cool features that they're adding to their platform all the time. You always know it's a good broker when they're constantly taking on feedback and adding new features. And that's what I really love to see. Look at this. We have the customization windows now. We can set up a whole bunch of different custom windows. And on top of that, we can add it like we want to. You can just basically, it's like pick and mix. We can pick and mix the types of things we want to have on the charts. If you want to have the bid ask, if you want to have the options, the implied volatility, all of these things on your screen, you can do so. Clocks for different places around the world. Of course, when you know the markets are opening, the order screen, the news, you can select the country you want the news from. And that's just to name a few. But then we can just continue to add these types of things. If we want to add a chart to the screen, it's as easy as this. And then we can make it as big or as small as we want. So if we want that to take that area of the screen, we can just add it in. The other cool thing is just you can put whatever you want. If it's your portfolio, if it's your positions, if it's other order windows that you want to have a few up, live news, options, clocks, it just doesn't really matter. They're constantly adding to this. My personal favorite, add a little watch list, customize your watch list. And then, of course, configure that to the area of the screen that you'd like it to be on. So if you're interested in Tiger Brokers platform and all of the extra features that it does offer, they have a whole bunch of special offers for you guys down in the link in the description down below. And of course, for our Australian viewers out there, I also managed to get you a few extra stocks. So of course, you do get also an extra 20 Zip stocks. And at the time of recording, I tell you what, they've gone up a little bit. Lucky I picked Zip. Thanks so much. And of course, if you're interested, check it out down below, guys. So let's jump into the charts here and begin by talking about VIX. And of course, the volatility just dropped. We saw the markets go up. What happens? Volatility drops. We've been talking about kind of this 21 to 20 zone for a while. Really, ever since we fell through 24, the most likely scenario was to go back down to here. There's a few reasons why, and this comes back to the question of the day, maximum pain. When everyone believes something is happening, let's say everyone wants to short the market, often the market will go long, and it will go vice versa, of course, in the other way. The VIX is also kind of showing us this. Maybe the volatility needs to drop off completely to convince everyone that the markets will incessantly go up forever and they won't pull back. That's kind of rare. Generally, markets do pull back. Doesn't mean that we don't get we may get a new low, we may not get a new low, we don't know that yet. But the VIX here at 20 into 19 still makes sense. And that would push that idea of maybe the stocks going a little bit higher first. We'll look at that soon. Of course, here we also have our other chart, which is the SP 500 stocks above the 50-day average. And you can see it's at those peaks that we saw previously, that 28th of March. We didn't drop off straight after that. Remember, we hovered around for a little while and then we floated on down. At this point, we're at some pretty pinnacle highs here. Something to be careful of, be nimble, be fast, have a plan. Obviously, if your plan's multiple years and you've been picking up stocks, hey, well, it's not the worst price in the world. At least you're getting a discount on many people at lots of times. Let's have a look now at the US dollar. So we obviously talked about the US dollar dropping down. It then went through this trend line down here, hit the big daily trend line and bounced up. Now in the last session, you'll see I've highlighted this little zone. There was an area where we saw the market pull back down to. We expected at the time of the previous video's recording, the market will pull back down. It did, it rallied, it dropped, and it was looking like it wanted to make a new low, and then all of a sudden, it just went boom, boom, boom. We saw basically this big rejection. Huge movement here. So I've highlighted this as a box area. This is super important. 105 or 106 straight on the DXY. If that now gets closed below, basically we've gone rally, drop, new peak, bust down, pull back, most likely short at that point. That would be a very key zone in this market. If this continues to hold though, it's become a bit of a what we'd call defended area now. If it continues to hold, there's a real chance that the US dollar could continue to rally here. And that would be interesting because it's counter logic. The markets are going up, but if the US dollar is also going up, does that make sense? Not really. And that will come back to yields in just a few moments. So for now, it does look like the US dollar, at least short time frame, is looking a little bullish. To get bearish on this again, it's probably going to need to get underneath this 106 level. And then of course, a little pullback followed by most likely some pressure onto that trend line down below. But yeah, the small time frames here moving a little bit bullish. That's moved over to the euro as well. We see the euro came down to a pretty important point. I had this one highlighted. This is the previous defended area. This zone is monstrous. I mean, this has been where all the buyers have been committed. Maybe even like a quick take of that would be pretty big deal. At this stage, yeah, it's just this zone has just been so impeccable at picking up levels. And I think that's really where the bulls and the bears are truly fighting it out on this chart. Maybe more pressure, especially if the DXY goes up. We, of course, expect the euro US dollar to go down at that point. And for you to go bullish on this, you're going to want it through that 1.02 plus. And that, of course, is similar to, again, the DXY. Synergize them together. That's how you trade these currencies and these types of markets. Let's move over to US oil. US oil made a new low. It actually got underneath. So this is, again, it's looking pretty bearish. I mean, that's what it kind of is showing us. It's showing us that pullbacks should be met by probably sell demand. I'm not sure with oil at the moment. It's really tough. I mean, I am basically bearish on it over the next months into the end of the year overall. But these intraday movements have been pretty dodge. There's been like that big breakout over here. We've already documented it. Go back and watch one of our other videos. We discussed that at quite a lot of depth. And I just think that at this stage, the market obviously just shows you short. There's clear cases to be made for something like a 65 or of course an $85 oil barrel. And I do think at some point we get that. But again, if you're looking on the charts, it's mostly bearish. If you're in the bearish position, it's hard to look at it any other way. Let's move over to gold. So gold's been rallying here a little bit. Again, big defended area, 1750, kind of 354. We're defending that zone, and at this stage, we're pushing a little bit higher. The trend still has changed now on things like the 15 minutes. So we were going kind of like higher peak, higher trough, higher peak. We breached underneath, we've pulled back, and somewhere in here, you could see sellers come back in. Again, a lot of it's got to do with the US dollar, 17.80, and really around where it is at the time of this recording. You're looking for that potential shift in smaller time frame. Has it happened yet? Absolutely not. Will it happen? We don't know. Of course, the big defended zone for buyers, 17.50. But I have a suspicion, even though I'm very bullish on gold, don't get me wrong, I'm not feeling bearish on it over the next couple of months here. I still think that there's a good chance that we pull back a little bit first before resuming that upward trend. We've got all this so far. We had that level, we've hit the zone, and now, you know, it could be some weakness before further strength. That would just make sense. That was a very aggressive trend, and I know a lot of you in the comments section were loving that on gold. So time to be a little bit cautious here on that one, but we will update you on money flow later on. Copper, not looking so good. This doesn't bode well for metals or really oil. So you can see here copper weakening trend and showing us that we have a key level here around 3.45-ish. And if we now breach underneath that and close, we probably are moving a little bit lower, maybe to 3.35. Weakness in copper most likely means weakness in a whole bunch of other commodities. So watch the commodity space over the next 24 hours. This one's probably going to be fairly hectic, I would say. Tesla did really well, moved up and got close to that sell zone again. It didn't do anywhere near as well, though, as some of the other stocks in the market. So Tesla losing a little bit of steam. It's still hovering between that resistance and this area. If we do break this level, though, this box level here, could we go back to the trend line? Just remember where that trend line is. That was the April one. So that's where we saw Tesla go bonkers into April, and it rallied and then it sold off. And so far, could we get a super rally? 1050 would be the level. I'm not too sure. We'd have to break through this and the market would have to go pretty euphoric. So we'll discuss that concept in a few minutes. We've got Apple here hitting that resistance we discussed in the previous video. Ooh, I'm not sure. I mean, Apple here, the next level would be up at this range if you're still bullish, 171.20. It hit a zone that I felt pretty comfortable with, and that was good. I mean, I'm happy with that one. I guess if it takes it, it goes to 171, so maybe day traders will be looking at that. But again, I think Apple is more of a proxy to get better returns out of it if you see the Nasdaq going. So if you believe the Nasdaq and the SP 500 going long, you'll see here Apple was 3.82% up on the last session. Hey, that's better than the Nasdaq. It's done pretty damn well. We'll move over to the 2-year here just so we can understand yields. Remember, yields are currently going up. 2-year and 10-year both up. However, the market's going up and the US dollar is going up. Strange. Does that really compute to a healthy stock market run? Why is the hedge going up and the yield going up? Kind of reminds me again of March and April of 2022. That's exactly what we saw happening over there. Remember the max pain concepts. If we go over here, yes, it was much more steep, but we were literally flying on the yield at the same time as the market was going up. Well, at this stage, yield's improving. Imagine if this blows off the new high and we still go up in the stock market. Ooh, be careful. Maybe set some alerts here. Somewhere around 3.3% if we go above that on the 2-year. It's not really boding well here for the stock market, I would say. XJO, let's take a look at the ASX 200. So it's at that roll reversal. Again, ASX making that little higher point. It's just moving with the US stock market at this stage, but you've got that support, you've got this resistance. Obviously, if commodities come under pressure, you would expect the XJO to falter a little bit. The ASX 200 here in Australia has a lot of commodities and, of course, energy stocks and all of those types of things. A new low underneath this level here will not be boding well for it, and that's about 69.16. So we'll keep a look at the XJO over the next couple of weeks. Let's move over to the DAX here. What's going on in the DAX? Well, it bounced off the area. Anyone that's trading the German market, probably feeling okay right now. Went up a little bit. Gap fell 13,000, just under 13,800. Will we get it? Seems likely. Again, this is kind of boding for potential further runs here in the stock markets around the world before potential maximum pain. We've got there that nice little gap that was left, and we're right about to test it. You can see those highs. Maybe we get that in the next 24 hours. IWM hits close to the first target, that 190. We basically got, well, we actually got it, 190.15. Not bad for IWM. Anywhere between this high here and all of this support, you would expect IWM to potentially have a pullback. So we're right entering into these zones. That's what we're doing. We're entering in. People that have been bullish, if you can't believe why, well, just look at it. It broke the trend line. It's entering into the horizontal support and resistance areas. All of this is very feasible. And certainly we just hit the big first take profit on the last 24 hours. So congrats to people that have got that. S&P 500, so many gaps. How many gaps, guys? We left another one in the previous session. I just want to bring S&P and then we'll look at the actual US 500 in a second. Here's the R1, those green dotted lines. That's sitting actually right on 42.72-ish. That's where that gap is from all that long time ago, the gap that was forced over here. So are we going to move into this level? Super interesting if we do. Anything from here to here, we've been speculating is kind of what could be excess phase in this current run. Remember, this is the A, the B, and the C. So we've got our A, we've got the B, and this is the C. Where does the C stop? It's the impulse move here. We're getting that kind of nice movement. Everyone can't believe it. The price action still always remained bullish at this point. And while we're leaving gap after gap after gap after gap after gap behind, hey, we might come back and fill them later, but at this stage, follow that trend until it doesn't tell you to be following it anymore. And at this stage, we've still been following it. Nasdaq, before we get to the US 500 futures, you can see here that big downward trend. I posted this on Twitter today. Follow us at FX Evolution, and you'll notice that downward trend. Check that out. So we've got two key levels here. We've got the zone that we just boxed up right around this trend line, very close to it right now. And then we also have, of course, the 61.8 fib, which would take us above these two highs over here, or three highs over here. And if you think about it, it's always worthwhile going back and having a look at previous pullbacks. So if we go to just this pull, you'll notice the fib 61.8 just above those previous highs, traps people in, bam, down. So that's where you're looking for that market structure of turn. And that's what we're hoping for in here. We're looking now for structure while still remaining intraday cautiously bullish on these moves, because of course they are breaking out towards the upside, just being nimble and fast. Let's go down to the big barometer here, which is the US 500. In the previous video, we discussed this idea of the 40-80 remaining to hold. And I tell you what, for futures traders, it was all about the London session. That was where the entry was. It was really nice, actually, but it happened before the stock market opened and it just ramped off. There's a little gap here between 41, I think about 10, 20, and the 40-90 zone on the real market. So that's now been left. And at this stage, we've broken to a new high. Now, most of your indicators, if you're loading indicators onto the screen, they're all going to probably be screaming divergence on you. That doesn't mean the market has to go down, but they will be screaming divergence on you. I'm almost positive of that. This becomes super critical zone. If the market did this and then rallied, oh, no. We would not trust that rally. So just remember 40-80, 40-90, worthwhile setting alerts for, focusing in on in the future. For now, though, we're above price. So that means that there's a chance that each one of these pullbacks into zones like these previous highs could be met by buy demand. You're looking at a mixture of putting fibs on the charts right now, basically taking those pulls, loading up 38.2s and 50s, looking at the previous highs, and then it's still, until further notice is given, really just a bullish market. There's not much you can do about it. It is what it is. If you want to take shorts, hey, you can do it, but practice risk management. And obviously a lot of people are doing it with options, which could be one of the better ways to do it, just because at least you can limit your risk. Speaking of options, let's go in here to the expiration come Friday, and you'll notice that there's an equal number of calls and puts now sitting around that 410 level on the SPY. We still haven't got the huge amount of bullishness that I think so many people are still bearish in this market. Maybe we do need that final kind of unbelievable move. Let's go 42.76. Everyone's like, whoa, yeah, it's so great. The market's so great. Look at us. We're so fantastic. And then you get some maximum pain. Still lots of options expiring. 400, that key big second support, and 390, the big level moving forward. If the market is to pull back down, these are where the options are expiring. And unfortunately, it looks like at this stage, these people won't be getting any cheddar. There's no salmon for them. They're not making any money. The bear salmon is gone, according to the Fed. Let's move over here from Bitcoin's perspective. Nice little support. Nothing much to really say here. It's kind of bouncing. Again, I don't know. Crypto hasn't interested me in the last months, really. I know there's gains here, guys, but I'm looking at this from the perspective of the Nasdaq, really. If the Nasdaq continues to do well, maybe crypto comes with it. But this has been really weak, and it kind of shows me sentiment is not as strong as I would like in crypto. Look for a new high here. Maybe that pushes us to bake testing that 24 or even 25. So I'm not all negative on it, but yeah, I'm just looking at it more from the halving perspective at this stage. If you haven't already, come and follow us at FX Evolution on Twitter. Of course, check us out there. And for the news coming out moving forward, we have the Bank of England monetary policy, 7 a.m. New York time. Then we have on Friday, the big one here, which is non-farm payrolls. Expect things to taper off ahead of this event. Usually you see a slowdown in volatility and a bit of chill until we get into that. So Thursday still could be fireworks, but then Friday, that kind of aftermarket, usually we'll just kind of see it floating around, waiting for 8:30 a.m. New York time, the jobs numbers. Always a fun one to watch. Remember, it usually goes in the wrong direction and then goes opposite to that a few minutes later, if not a few hours later, or a few, maybe half an hour later. So be careful of those types of events, guys. So if you're interested in finding out more about the special offers from Tiger Brokers, check out the link in the description down below. And of course, as always, remember to subscribe and smash that like button. Thanks so much for watching, everyone. We'll see you in the next video. And again, thanks on the 100K. We really appreciate it.